Microsoft just had their developer keynote and they announced a lot of new things. But there were three primary announcements that really put pressure on Microsoft competitors. The first one is Windows Copilot. Microsoft is merging ChatGPT technology with the Windows interface. Then we have Bing ChatGPT. So like Google, they're merging AI with their Bing service. And then they announced Azure AI Studio, the integration of AI into their Azure service, which will put immense pressure on their competitors, primarily AWS. So Microsoft is going after numerous big tech competitors, and they're doing so at the same time. And then we also have news that one of the companies I recently purchased into reported its earnings and it was subpar. In fact, investors didn't like the earnings of Intuit, and the stock is currently traded down around 6% after earnings. We'll be taking a look at their earnings and seeing how bad it really was. And then we also have a report from the Wall Street Journal that stocks are buying back their own shares at a torrid pace. And it goes through and highlights which stocks are doing the most buybacks and what this typically means for the stock market. So as always, we have a lot to get to in this episode. Let's go ahead and jump in. Now let's first start off with an update on my portfolio, and specifically one of the companies that I recently bought into that just reported earnings. We have Intuit. I added Intuit as a concentrated core position into my portfolio last week, and my previous video highlighted why I purchased the company. I went over the entire investment thesis and why I believe this company is a great investment over the next 5 to 10 years. Intuit, as I highlighted in the previous episode, is a company that I consider to be a quality compounder, a company that has a franchise suite of software that all has a wide moat, entrenched market position, incredibly high barriers to entry, great economics, and a long runway of organic growth and pricing power. Overall, I think Intuit is a fantastic company that doesn't get paid to quite as much because it's not a flashy tech company. So after going over the company's qualities and the fundamentals and the valuation based on its free cash flow yield, I decided to add it to the portfolio, buying in $24,000 over the past 5 days. That makes up around a 5% position. So my core positions are around 10%. This one's currently about a half-size position. Now, Intuit recently reported earnings, and it was a little bit underwhelming to investors. They did beat on their earnings per share, but they missed on their revenue guidance by a narrow miss. So they narrowly missed on their revenue. This caused the stock to sell down around 7% today, so it's trading down a little bit today. Now, this has caused a lot of people to look at this and say, well, Joseph bought into this company 5 days ago, and they reported earnings, and the earnings were bad. Therefore, that makes this investment a terrible investment. It was an ill-conceived investment from the beginning, because now it's sold off right after being bought into. And I want to address those claims. So first of all, let's go ahead and just take a look at what's happened over the past 5 days. Right now, as of buying into Intuit, I am down less than 4% on this holding. Intuit's stock price is back to where it was 5 days ago. And it's where it was about 8 days ago and 12 days ago. In fact, Intuit year to date is still up around 8%. And it's repeatedly traded around this much. The jump from this point to this point was 5%. The jump from this point to this point was 5%. Same from hair to hair and hair to hair and hair to hair and hair to hair. Those are all 5% or more. In fact, so far year to date, Intuit has had over 6 different times where it's traded above 5% in just a day or two. So volatility is something that is not rare for this company. But even so, I still see comments of people looking at the past week and saying that the company's gone down, therefore it's a bad investment. So let me just address those comments, which I think are frankly dangerous to any investor. To address these comments, I want to highlight a couple facts here. The first fact that I want to highlight, and these aren't really arguments, these are just facts. If you judge the performance of an investment on a 5-day period, you are not an investor. I don't know what you are, but you're not an investor. You're not investing. You're not doing value investing. You're not doing growth investing. You're not doing any type of investing. If you're judging the performance of any company, Intuit included, on a 5-day period, then you're a trader. You're a gambler. You're somebody that likes to base things off of market trading day in and day out. That's not the game that I'm playing here. The game that I'm playing is long-term fundamental driven investing in companies that I believe the intrinsic value will grow over a 5-year period. The second thing that I'd point out, if you let a short-term market trading instruct you or inform you on value, you're also not an investor. If you're looking at the price of a company and the fact that the price goes down makes you feel like the investment was a bad investment, or the fact that the price goes up makes you feel like it was a good investment. If that's the way that you're investing, then what you're doing is looking for other market participants to instruct you on the value of a company. Well, the company went up in price, therefore the intrinsic value must have grown. That's not necessarily so. If that was the case, we could go back to companies like Fubo. We can look at the price chart here, look over the past 5 years, and if you simply took the approach that the company was worth more money, then during 2020, Fubo was really worth $50 per share intrinsically. You'd have to believe that that was the true value of the company. Clearly, that was not correct. Investors didn't know what they were doing, and they got overly hyped and excited about a low-quality company, bidding it up to extremely high valuations far above any level of fundamental or intrinsic value. Fundamental value investors do not look at short-term market volatility or the bids of other market participants to instruct them on the intrinsic value of a company. They recognize that the valuation is based off of cash flow and future growth prospects. So if you let short-term market trading instruct you, inform you, or educate you on the value of a company, you're not an investor. You're certainly not a fundamentally driven value investor. And then finally, number 3, value investors judge an investment based on the fundamental and intrinsic value improvements or declines, not the market trading. This is one of the hardest things for investors to do, to disconnect from market trading and actually look at the intrinsic value drivers of a company. It's so difficult to do because we have these numbers glaring in our face all the time. We have the Dow Jones and the NASDAQ and the S&P 500. When these go down, other companies go down, in some cases more. We have the numbers, the quote price, every single day, every hour of every company on every financial service. And in many cases, it's very difficult to disconnect from this mentally. But as fundamentally driven value investors, that's something that you're required to do. You have to disconnect from the market trading. When I look at the value of Intuit or any other company, I judge it based on the fundamental direction and developments of the company. And when we judge this company in particular on its fundamental developments, we have them right here. Based on last quarter, the revenue grew 7% year over year. That's against very tough comps. The operating income grew 16% year over year. The earnings per share on a GAAP basis grew 18% year over year. All 3 core parts of the growth profile of this company are going along quite nicely. The intrinsic value has increased for Intuit, not decreased. They also said in the earnings call that they're raising their full year guidance for operating income, revenue, and earnings per share. So they're not guiding down, they're actually guiding up. And in terms of short-term market trading, this is something that I really do not concern myself with at all. I'm so used to this. I've done this for long enough and I've seen this so many times that I know better by now. Every single one of my companies, and especially the best buys that I've done, have had quarters where they sell off immediately after the quarter. I've owned Apple for over 5 years. This company has had so many cases where it sells off 5%, 10%, or has a 20% dip. It's countless the amount of times that's happened. Microsoft is another company that I started to load up into, and the company traded down. Satya Nadella sold out of the company, the stock price went down, and I ended up in the red around $5,000. What I had to do, which was difficult to do with Microsoft, was ignore all the comments of people saying it was overvalued and just wait. And waiting made that $5,000 in the red turn to $7,500 in the green. Because Microsoft is a great company, it is a compounder, and when you wait long enough with compounders, they work their way back into the green. Vici was a company that I first bought into, and it went heavily in the red. This is a company that I was openly mocked for buying because it was overvalued, and it went into the red right after I bought it, and I received a number of critical comments after buying into this one. Simply waiting brought this one back into the green. The same story for Texas Roadhouse. This company went into the red immediately after buying it. The same thing with Starbucks. I bought Starbucks at $90 per share, and it went all the way down to $70 per share based off of labor concerns and unionization. What I had to do with these holdings to turn them from losses into gains was simply ignore the critics and wait. With quality companies, it doesn't take much. It just takes what Peter Lynch calls having a strong stomach, avoiding the temptation to sell out of quality companies, and simply waiting. Waiting in both cases turned both of these losers back into winners. So in terms of Intuit, having the quarter trade down a little bit after earnings does not concern me. And if this concerns you, that's fine. You should buy an ETF because in almost every case, every company you buy, they're going to have time periods where they trade down after earnings. That just comes along with individual investing. But overall, I'm happy with the report. I think Intuit's doing a great job, and they addressed a lot of the concerns that investors have as well about upcoming developments. One of the biggest concerns that investors had about Intuit, one of the things I heard the most, was the recent news that the Fed is coming out with free tax filing software. And the concern is that a government-provided free tax filing software is going to impact Intuit by taking customers. Here's what they had to say on the earnings call. If you look at the last 4 years plus, there were several entrants, big entrants into the free tax software. One was Credit Karma before we acquired them, where they have 100 million plus customers, a trusted platform, and they entered into the market providing free tax software with sort of a very little, no impact. So that's the first thing they highlight here. Credit Karma, one of the companies they now own, previously had a free tax filing software competitor to Intuit, and it had almost no traction. They said the point is that free tax software is already available, has been available to every customer, and the awareness is extremely high. And so to have another sort of free tax software that's available is really immaterial in the way that we think about it. And I'll remind you, by the way, it's actually not free. This is going to cost taxpayers billions of dollars, and so it's really not free. So they're pointing out that the government developing this product is not going to be free because it costs taxpayer money. Now, another thing I wanted to highlight is part of the strategic execution this company's doing, something that I think is very significant. They say that their desktop ecosystem revenue grew 16% and desktop enterprise revenue grew 20%. So Intuit has a whole portion of their customer base that is using desktop applications. And they mentioned that we are over halfway through a 3-year transition to a subscription model for our desktop accounting solutions, making this revenue more predictable. We also raised our desktop prices for several products last September to price for value. So what I believe they're doing here is they're trying to shift all of their desktop users over to the online SaaS solution where they have more of a reoccurring revenue and more predictable pricing power. This is the same exact transition that Adobe did 10 years ago. And we can look at the impact that this transition had on Adobe's business. The revenue, for example, of Adobe was basically flat for about 6 or 7 years from 2007 to 2014. This is precisely when they shifted from desktop to a SaaS model. The revenue suddenly exploded, growing at a rapid rate. And Adobe was a legacy business that had been around for decades before this pivotal point. Transitioning from desktop to SaaS model online with constant updates and reoccurring revenue really helped out this company. You can see the same type of things in the cash flows. Basically flat for about 6 or 7 years, and then it exploded as soon as they switched over to the SaaS model away from desktop. Intuit right now is in the transition of switching their users over from desktop to the SaaS model. And this is for their biggest part of their franchise, for QuickBooks and TurboTax. They said looking ahead, we expect continued strong desktop ecosystem revenue over the next quarter as we complete the remaining part of the 3-year transition. We will continue to build out our online ecosystem and help our desktop customers migrate seamlessly to our online offering when they're ready. We continue to expect the online ecosystem to be our growth catalyst long term. So that is where their major focus is, the long-term growth of their online ecosystem. And here we have Intuit amidst that transition currently. I think this will be a long-term growth driver for the company. So what I saw is a company that's still executing on their plan, growing their earnings per share, growing their revenue, growing their operating income, and transitioning their clients from legacy desktop over to SaaS solution. Overall, I think the future is very bright for Intuit. Now, not everyone shares in my enthusiasm for the success of Intuit. In fact, a lot of people seem to really hate this company. Part of the feedback I received in the last episode is that Intuit, bad. That's the feedback I received. Intuit is bad. Here's one of the comments on the last video. With all due respect, I hope Intuit goes out of business. 84 thumbs up. Lots of people do not like Intuit because they deal with taxes, and worse yet, Intuit lobbies the government. They spend millions of dollars lobbying the government. They lobby the government as they sit there, all the board of directors and the executives of Intuit. They sit there conspiring together in the dimly lit rooms, only lit by the light of their cigar, and they talk about how they're going to make the tax system further complex so that they can have the solution. It's like creating a problem that they have the antidote to. This is the big conspiracy of Intuit and why so many people seemingly hate it. Now let me just address this for a second here. First of all, it is true that Intuit does lobbying. They spend around $2 million per year on lobbying, which is pretty run-of-the-mill. Virtually every large company, especially tech companies, lobby for their own benefit. Every single one of them. Google spent over $20 million in lobbying last year, over 10 times the amount that Intuit did. Every large company in the US spends lobbying to inform and help direct policy that they think will be beneficial to both people and their shareholders. Intuit is being blamed by some people for making the tax system complex. And to that, I just have a hard time keeping a straight face when I read those comments. Do you think that $2 million of lobbying, $2 million, is what's causing the US tax system and all of federal taxes to be complex? Is that really the stance you're taking? Intuit is the cause of the entire United States government having a complex tax system. I'm sorry to be the buzzkill if you actually believe that, but that's not the reason why. Our tax system has been far complex, far before Intuit had anything to do with it. Intuit takes an incredibly complex tax system and boils it down to a very easy to use interface so that their customers can actually navigate a problem the government has created long ago. A second thing that I'll mention is virtually every company that I've ever invested in is evil for one reason or another. I always get the same response. This company is bad, bad, bad for XYZ reasons. S&P Global? Well, I can't invest in that company. Look what they did back in 2007. They got all the ratings wrong on the mortgage crisis, and they caused a huge economic crisis. That's all their fault. This company's bad. MasterCard. This company's monopolistic. They run a duopoly with Visa. They leech off of the American system, getting a revenue share of every single transaction, and they hurt small businesses. Microsoft is so big and powerful that they just spread out into every single category of product, and they're this unmitigated monopolistic company. They've exercised so much power over so many industries that they're virtually unstoppable at this point. This company's bad for society because of how big and how much control they have. Apple charges developers 15% or 30% of their take in every transaction of the Apple Store. That's an unfair monopoly. Apple's bad. In the real estate category, Vici owns a lot of gambling real estate. And as we know, gambling's a bad addiction and causes lots of problems. Vici's bad. In the restaurant category, Texas Roadhouse is contributing to global warming. Starbucks is a union buster. It's bad to go against unions. In industrials, there's no industry that treats their employees worse than railroads. Railroads treat their employees horrible. The railroads are bad. In the consumer category, Costco shut things down during COVID and made people wear masks. Pepsi's causing obesity and making people die early. Nike has child labor, and Estee Lauder does business in China. For one reason or another, all of these companies are bad as well. So let me be clear on this. When I'm doing analysis on companies, my goal is not to try to figure out the best way the world should be ran and try to project my own morality or thoughts onto these companies. What I'm doing as an investor is making investments in already well-established companies, and then I'm modeling out what I believe will be the likely probable outcome over the future. Companies that I think will likely have a great deal of success, and I'm making large concentrated positions into those companies. This has nothing to do with me trying to judge morality, trying to say how I think these companies should be, or things overall should operate. This is what I believe the reality is in the world we live in. So if you think that Intuit's a bad company, that's fine. You can have that viewpoint. I personally think that you're wrong, but in terms of my actual investing, it doesn't make a difference. Now moving on, we have some major news, which was Microsoft's keynote, and they announced 3 big advancements in AI that I believe will be impactful to both Microsoft and their largest competitors. The first one is the merging of AI into Windows.
Next, we're bringing the Copilot to the biggest canvas of all, Windows. You're going to hear a lot from Panos tomorrow about it, but I think that this is going to make every user a power user of Windows. Let's roll the video.
It shows a panel off to the right of Windows where it pops out, and then it's basically ChatGPT right on your desktop. I see Microsoft taking a note from Apple. Apple likes to do this with their devices. They put their products right in the forefront. They default their own products. And Microsoft is doing this with Windows. Defaulting Copilot is a very, very Apple-like move. And I actually believe that this integration of AI into Windows, I think it pressures Apple. Apple has a great ecosystem. They have a great operating system. I think that users really like it, but it doesn't have a deep level of AI already integrated into it. If Windows starts coming in with these huge integrations, I think it's going to put pressure on Apple to at least match the capability of Microsoft, which may be difficult to do. We'll see how Apple responds later this year, but they are already doing this. Now, the next thing that Microsoft is doing is merging ChatGPT AI technology into Bing Search. This isn't a surprise. It's something we knew that they were doing before, but they're really not taking any half measures here. They're doing a fully fledged integration.
Look, ChatGPT is the most sort of fast-growing consumer app we've ever seen. And search grounding is a very key feature, right? So that all the information is current and grounded by what you have from the crawl and the index. And so it's fantastic to see that.
Previously, ChatGPT was based on models that were static models. It wasn't hooked up to search. Now ChatGPT will have the power of live search, which will make it massively more powerful.
We're excited to be able to, it's going to launch in ChatGPT Plus immediately and quickly coming even to the free tier. And this is just the start of what we plan to do with our partners in OpenAI to bring the best of Bing to the ChatGPT experience.
Now, of course, this market is currently owned by Google. They have the leading market share, and most analysts expect Google to continue with their massive market share lead. So right now, most investors are not really underwriting that Microsoft is going to take massive market share from Google. But there's always a chance that they can actually make some gains. If they're pushing this hard, making ChatGPT and Bing this good, they do have a chance at really competing with Google. But Satya wasn't done there. He announced another big integration of AI into existing Microsoft technology, this time into Azure.
Of course, when we talk about the AI platform and the Copilot stack, the next thing for us, which is really exciting, is AI Studio. This is the full life cycle tool chain for you to be able to build your intelligent AI apps and your copilots. Everything from being able to train your own models to be able to then ground, whether it's OpenAI or any open source model, with data that you bring, built-in vector indexing in Azure Search, built-in support for RAG or retrieval augmented generation support, built-in support for prompt engineering with prompt flow and orchestration, and of course, built-in support for perhaps the most important feature, which is AI safety.
Now Azure has its full-on AI studio with a variety of features built into it that developers can build upon. Very similar to Amazon's AWS and the AI move that they made. And in this, we have Microsoft again putting massive pressure on another big tech company, this time Amazon. Now, I'm not saying that Microsoft is going to destroy Apple or Google or Amazon. I don't believe that will happen. But what we do see here is Microsoft continually being incredibly aggressively competitive with even their biggest peers. Microsoft doesn't stay in their lane. They continually move out of their lane into competitors' categories and incrementally shave away market share. They're doing that with desktop OS, they're doing that with search, and they're doing that with cloud. Microsoft continues to be great at taking market share in different categories. Now, in terms of valuation, Microsoft has had an incredible run. It's up 32% year to date. I believe there's a lot of enthusiasm being priced into the stock now with all of the AI news. So I think we have a lot of AI enthusiasm into this free cash flow yield. I think it's a little bit of excitement. Currently, right now, I'm holding the stock, but I am not buying it. So right now, it just remains a hold. Now, moving on, we have another piece of news that I wanted to dive into. It's a report from the Wall Street Journal on buybacks, and it says that they're happening at a torrid pace. And I wanted to address this because I feel like so often buybacks are misunderstood by investors, they're misunderstood by Congress, and they're often highlighted in a very negative light. Now, we have news here. that companies in the Russell 3000 have unveiled plans to buy back more than 600 billion shares this year, in line with last year's record pace. Last year, buybacks amounted to 1.27 trillion of share repurchases, and there was a completed 1.05 trillion in buybacks in 2022. So over $1 trillion in buybacks, and you can see that right here. A record year in 2022. We're on track to possibly beat that in 2023. So massive amounts of buybacks, and this always draws a lot of attention. Why aren't these companies investing in future growth, or so on and so forth? Let me show an illustration of what a buyback actually is. We have right here in the top left a company, represented by this stick figure. This stick figure is the company, the person that started the company, and they run a publicly traded company. The company chooses to do a buyback. Well, we have two different shareholders. Let's say that we have shareholder 1 right here, and then we have shareholder 2 right here. Shareholder 2 doesn't want to have a stake in this company anymore. So what does he do? He sells his shares back to the company. The company bought back shares from shareholder 2. So shareholder 2 is out. He has his cash, he's moved on, he's doing other things now. Now, since there's less shareholders, shareholder 1 has a bigger proportion ownership of the company and enjoys a bigger portion of the profits. And in this exchange of a buyback, nobody was harmed. There are no victims. It is a mutual transaction amongst investors in a company. The company is simply trading shares from some of its investors who are choosing to exit out of the company and sell their position, further increasing the stake of the existing investors. There are no victims in the process of a buyback. Buybacks also have a lot of benefits. For example, when a company's price goes down and investors are looking to sell, it's nice for the company to be able to scoop back up those shares at lower prices. With Intuit trading down today, for example, this is a company that likes to do a lot of buybacks. So as the stock price trades down, Intuit will buy back these shares from investors looking to sell, further increasing the stake that I have in Intuit without me buying any additional shares. So we look at news like this, that buybacks are at record high. Don't let the media convince you that that's an alarming thing or something that's inherently bad. In most cases, it's not a bad thing. Now that's all the update for this episode. I'll have more content out later this week, so make sure you're subscribed, and I'll see you in the next one.